people will be looking very closely at this report to see what it tells us about the outlook after those two ISM reports. Let's take a quick look at what the expectations are and talk about what would be worse and what would be better when it comes to signaling a recession. We're looking for 140,000 non-farm payrolls. That's the updated estimate this morning. Unemployment rate at 3.7. Average hourly wages growing at 0.3%. And there's the ADP payroll number we reported yesterday at 135, which is in line with the non-farm payroll estimate. I bring this up to show you this would be okay. If we were right in this zone here, it would be along with the expectations that the job market was cooling back down towards trend, where the economy is slowed as well along with it. So what are we looking for? Let's take a look at some of the clues that economists might be looking at. First of all, obviously, does the job numbers soften more than expectations? This 140 number, you get down to 100, there'll be real concern about weakness. Another clue, does the work week get shorter? It has been trending down over time since the beginning of the year, and that's something employers might do before they get rid of workers, is they shorten the work week. And then we've had a pretty good influx into the workforce here. If you have a weaker jobs market, you might have workers leaving the workforce. Take a quick look at those ISM numbers, and we put them both on the same chart to show, hey, it's been weakening for about a year. September 2018 was probably the peak of the economy. They've been coming down. Neither, however, while manufacturing is in contraction, neither is in the zone that signals or where it would otherwise be when you have a broader recession or signaling a broader recession in the economy. Last thing I want to look at is how good is an indicator is jobs itself. Well, you can see people say it's coincident. It does soften ahead of time. There's obviously no real clues, but if you look ahead of the last recession, several months back, it does begin to soften. You can't guarantee that means a recession is coming, but we've had some of the softness that might be the beginning of weakness, but it's not necessarily down in the zones where it would really cause concern. Concern, though, is in the Fed funds futures market, where they have now ratcheted up 84% probability of a rate cut this month in October, and a 52% they brought forward another rate cut for December. So that would be another 50 basis points from here if the market has this right. And those are among the things, guys, I'll be talking to Eric Rosengren about later this afternoon.